Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug. Hey, Doug.
Hey, Kirk. How you doing today? It's gonna be fun. There's lots to talk about, and of course, it's a beautiful beginning to March Madness yesterday. So that's a fun tie-in to the March Madness of the markets and the economy that's going on right now. So
Yeah, it's full season. I can't speak. Doug's gonna have to take over today. It's full swing March Madness, and I know a lot of people watching the games. I'm not a basketball guy. I'm a hockey guy, so we can talk about that. But that gold medal or gold medals have already been won. So hopefully everybody else enjoys March Madness. That's not for me.
Yeah, March Madness is all about unpredictability, momentum shifts, and upsets, and that's what we're seeing in the markets. I mean, the brackets looked clean a few weeks ago. Soft landing talk continued, rate cuts coming, strong consumer, and now, hey, war risk, oil volatility, weakening jobs, housing, markets question the narrative. A lot of brackets already got busted.
Yeah, people need something to gamble on, Doug. If they don't gamble, what are they going to do? You got to have the Coliseum. You got to have you got to throw bread to the people and let them gamble.
Yep. Well, the number one seeds are vulnerable if we want to talk about Mag 7 and big tech, right? I mean, there's so many tie-ins. It's fun. Let's.
Yeah.
I'll let you start. Let's go.
All right. We'll dive right in today. So it's been an interesting markets, to say the least. We've been doing a lot with the markets since the war started, but at the end of the day, the thing to think about markets is you should be doing a whole lot of nothing. Now, I want to frame this correctly because I know the buy and hold people and be like, great, yeah, buy and hold, do nothing. Yeah, what I really mean is something different. We talked about this last week. When the war starts, you should just be on the sidelines until the war ends with pretty much all of your positions. And we've been spot on with that prediction, and I think we probably should have hammered the table harder. But we were a week into the war before we got this episode, the first war episode. But we're what, 3 weeks in now, and initially Trump said it would take 2 weeks, and then he said it would take a month, and I haven't seen him back off since then. But it's really hard to tell what's going on over there, and based on the market conditions, I don't watch the news, I watch the markets, because the markets are a better indicator of what's going on than the news. The news, who knows what's true? My son asked me the other day, he said, Dad, what's going on in Iran? Now, he and I talk about this, but it was, he watches TikTok and YouTube and all the things that kids do these days, those young whippersnappers. He's like, what's going on in Iran? And I said, well, I don't know, because who am I getting my information from? So I use it as a lesson to teach them about information and propaganda. And I was like, what do we really know? We don't really know much, right? We know that we've attacked their defense infrastructure. Okay, that I'd say is probably accurate. It sounds like we destroyed one of their oil, maybe it was a refinery, I don't remember which one it was, but it's basically part of the oil infrastructure. They apologized. It said Israel did it. Apologies, we didn't mean to do that. Well, that's odd. You're in a war. Why are you apologizing for destroying infrastructure in the middle of a war? It almost seems like maybe it's not a war. So, when you start to see all this stuff, it makes you say, isn't that interesting? Well, that's one of my favorite phrases, because when I see that in the market, it makes me say, isn't that interesting? Like the first day the war started, the market was up. That's not normal. And, in the last few weeks, especially the last 2 weeks, Monday, Tuesday, and Wednesday, the markets are up. And then Thursday, Friday, they're down. And the whole week they end up down. But you look at it, you're like, what is going on? Why is this happening? Well, we don't know. But based on conversations I've had and based on traders I've talked to and just overall smart people, the best guess that anyone come up with is that the market doesn't believe the war is going to continue. Now, if we had a forever war, which is pretty much every war we've ever had, with exception of Venezuela, which, kudos to Trump for going and kidnapping the president and not starting a war.
This doesn't sound good. I mean, when you spin it that way, all of a sudden it doesn't sound very
Yeah,
good.
because we basically didn't kidnap him. We just asked him to leave, and he came with us voluntarily and decided to stand trial on his own volition. Yeah, no, we didn't kidnap him. That would be illegal.
You are ready for politics there. Well, that was a beautiful.
We coaxed him into our plane with guns and pain, and he decided to come with his wife. Like, okay. Anyway, so. But, you know, when you see stuff like that and you see this, people are thinking like, well, this will end quickly. Well, we don't know, right? And frankly, every week that goes on, there's usually a kernel of, well, you better stick with us because it'll be over quickly. That was last week. Trump came out and said, don't fight the trend. No, Sunday night, I think he sent out a tweet or whatever is truth. He sent something out and said, well, you stick with us because it's going to be over soon. You're going to be sorry if you sell out now, or something to that effect. Well, that's what he said the day before the tariff tantrum ended, and the markets went up like 10%. And he warned everybody. Everybody's like, oh, okay, well, I better pay attention. I was too. On Monday, I was like, wow, we better pay attention. Well, the markets went up Monday, Tuesday, and Wednesday until the rate meeting with the Fed, and the Fed basically said nothing and did nothing, and nothing changed, but yet the market sold off. The probability of them changing the rates it's not zero because nothing's actually zero, but it's near zero. It's as close to zero as you can get without actually being zero. You know, there was absolutely no chance of them changing rates. And they didn't, and no one was surprised, and yet the markets dropped. So, you know, the language didn't change, nothing changed, but the market sold off. And so, you know, was it because of the rates? Well, that's how it's going to be spun. I don't agree with that because this is information everybody knew. I knew that. Everyone knew it. The only people that didn't know were Joe and Susie Public, who were watching Kramer on CNBC. They didn't know anything, and they know less because they watched Kramer. So,
but if they had invested correctly based off his advice by inversing, they would be rich now.
Yeah. So, you know, I think the thing to think about is as we're looking at markets, right, things don't necessarily make sense. Some things are making sense. Well, you see the treasury yields are going up, meaning the prices are going down, which is what you would expect if there's inflation. There's stocks are declining, certain areas like staples, if we're having inflation. You know, stocks like energy, I'm not going to talk about energy because obviously, you know, energy companies are going up because you're going to make more money. But that's about the only sector that's going up is energy. And it's going up a lot, but, you know, the rest of the areas pretty much are not. And the ones that were popping off right before the war have come back down. And so we're going to get back into the you know, the what is it? Somebody's called it the muddle through economy. We're going to have the muddle through stock market, where we're going to have a typical 2-year presidency where the stock market goes nowhere for the year. It might bounce around, but it'll probably end up nowhere. It's a little odd that the financials are up right now with all the problems in the financial sector, but everything else is pretty much down. Oil's up. So the thesis prior to the war is we were going to have rates dropping, we're going to have lower oil prices, lower inflation. But with the war going on, oil is up at 100 and change. Inflation is going to pick up. Now, I'm going to try to read through the news here. Okay, so bear with me. This is a speculation, but based on my experience, here's how I'm reading into it at the moment. So one read on it is, I still think that Trump wants to retain power in the midterms. In order to do that, lower oil prices, lower interest rates, lower mortgage rates. That will get him the best chance for retaining power in the midterms. Now, that being said, this is completely contradicting that thesis, because the war causes higher inflation, it causes more problems, lower earnings, lower stock market, all the things you think, well, that doesn't make any sense. Well, here's the thing. If he wraps up the war quickly, and I give him about a week till the end of the month, and even then, I think it may even be running it long in the tooth, but let's say end of the month, okay? If he wraps up, then I could make a case for we could pull it all together by midterms, okay? I still believe if he wraps it up in another week, and I don't know where the actual number is, but I'm guessing somewhere between now and a week. If he wraps it up, we're going to have oil prices down in the 40s by election time. I would put a big bet on that. Because we'll be flooding the market with oil because it's all really expensive oil, and they can throw it as much as they want at $100 oil. Why not? They're going to make tons of money. So they're going to flood the market, lots of supply in the market, which the same amount of demand, which means prices drop. So we'll probably see $40 oil, maybe high dollar range gas, unless you live in California, in which case it's probably still $10 a gallon. But that's your fault for living there. And I know you're going to say it's the weather, but I live in New England, so weather, whatever. The weather's different every day. So I just want to say this. The way to think about it is, so we really have two scenarios, and this will I'll wrap it back together, and I'll give it up to Doug. So wrapping it back together, there's really two scenarios that I have in place. And if you look at life, if you look at markets, if you look at gambling, if you look at whatever you're doing, and you're trying to predict the future, you're going to be wrong. We as human beings are very good at being wrong at predicting the future. That's our strength. We're really bad at being right. But you don't need to be right. What you need to do is you need to think of what are the most probable scenarios, okay? And then you come up with a game plan for each scenario. So my two scenarios, and there could be a third, but at the moment there's two. Scenario one is the war ends rather quickly, meaning like by the end of next week, the next 7 days. And then oil prices go through the floor, interest rates will start to drop, inflation's going to go down, not right away, but that'll be the direction. And all that brings a lot of money into staples, and utilities will probably still do fine, and bonds, and those will do very well. Mortgages, all those things will do well, okay, because yields are going down. Now, if this carries on, as I suspect it is, and it may, when you have BB out there talking about, oh, we could wrap this up any day. I saw him on TV yesterday. He was blabbering about something about it's just going to be wrapped up really soon. Well, that sounds like PR to me, because Trump said that 5 days ago, and maybe they were right. I don't know, but maybe they're also trying to goose the markets, and that's the issue. Is you have people out there cheerleading the markets to not drop through the floor. I wish they would. I wish they would go through the floor by 20%. I think it would be great. Then I could buy a bunch of great stuff and wait till it goes back up. But right now, the expensive markets are staying expensive. So this is why it makes sense to go really liquid in a war, is because you don't know the direction. Scenario one, bonds do well, mortgages do well, staples do well. Well, those would be the big beneficiaries. So that's if you have lower inflation. Those things should do the best. But if you have higher inflation, meaning the war continues, what's going to do well? Honestly, the market's expensive. I'm not sure anything's going to do well unless you're shorting. Maybe you're long the dollar. That might do well. I wouldn't buy oil at this point because it's already really expensive. Energy companies will do well. Sure, they've done really well. But once the war stops, I don't know if they will. So, it's a question. But, a lot of areas are going to become more expensive. People are going to be spending less. Inflation is going to be higher. So what does well? Cash. Cash might do okay, right? I mean, you think gold will do well, but gold's been way over its skis, as is all precious metals have been way over their skis for like the last 6 months. So I'm not sure that's a safe place to be. We had them plummet huge yesterday, as Trump would say. It's huge. I figure they're down like six. At one point, they're down like 10%. Like silver was down 10, mining stocks were down 10. It's crazy. They came back, but regardless, they were down a lot. So the real question is where do you want to be? Well, this is why being in cash is okay. And this circles back to my original conversation of do nothing. Flatten your portfolio and just sit. And this isn't advice. This is just how I'm thinking about it. I flatten the portfolios as much as possible, reduce the risk, keep things that I need to keep for very specific reasons, but everything else just get out and just sit in the sidelines. Maybe take some singles or doubles, but really these are the kind of markets where people lose a lot of money. So you want to be careful, and it's better just sit in the sidelines and wait until I know which scenario is correct. Because if scenario 2 is correct, I probably don't want to be in the market anyway. If scenario 1 is correct, I could easily get back in, because my portfolio, I had to dump a bunch of stuff because I was positioned incorrectly. So if it ends and it turns out that was the correct way, I can just jump back in, right? But if I had stayed, we'd be down, I don't know, probably like 6 to 8% more in our portfolio because all the stuff went down, right? And so why do you want to sit there and hold stuff that's going down? And if you're talking about, well, you got to buy the dip. Buy the dip is one of the dumbest things you could do. Buy the dip works in a bull market, not in a bear market. Okay, we talked about this before, but I'm just going to say it again. Buy the dip works in a bull market, not a bear market. So if you're buying the dip on crypto, if you're buying the dip on any of these other areas that are going down, you're shooting yourself in the foot. You're just lighting money on fire. Just because Bitcoin's down 50% or whatever it's down, I think it's going to go down 70. So if it goes from down 50 down 70, what's that? That's approximately a 50% loss if you buy the dip. Okay. Why do you want that? I wouldn't. I'm just going to wait. I'll just wait until, there's a comfortable in, and wait till nobody's paying attention. Everyone's disgusted by it. And then I'll get in if I do it all. But that's how I would think about assets. So don't be too eager to buy the dip. The markets are barely coming off their peaks, the indexes. I mean, we're down, 6% off the peak? It's crazy. It's nothing. So just be careful when you're investing. Don't get too eager in these markets. You're not going to lose by waiting. The markets haven't sold off in a big way. They're coming. I mean, we have not gone below the November lows in the indices. I think in the S&P, we still have not gone below the November lows. In the NASDAQ, I think we're still above that. So we still haven't gone below that. What does that mean? That means we're not close to done. So it could bounce off that. But if things get worse, then the indexes should get worse. If the market, if it bounces off that and Trump says, hey, we're done, we're going home, they might bounce. So I don't know. And that's why I'm not taking a bet on that, because I think it's a low probability bet that things are going to go higher. But if the markets are getting worse economically, the indexes should come down. And I expect they will at some point. I frankly don't know why they're not now, when you have energies keeping them up, and energy's 3% of the index. So, who knows? Who knows? I mean, I know the math works because I've checked it a bunch of times, but it's very weird. And it feels weird to everybody. When things don't make sense, just get out. Don't fight it. Don't make something happen that isn't going to happen, right? What's the quote by Bernard Shaw? I think it was, a reasonable man bends himself around the world, an unreasonable man bends the world around himself. We do not make progress without unreasonable men.
The reasonable man adapts himself to the world. Yeah. The unreasonable one persists in trying to adapt the world to himself. Therefore, all progress depends on the unreasonable man.
Correct. But in this case, you want to be the reasonable man, right? The unreasonable man loses money. What that references is technology and innovation. This is the stock market. The stock market does not reward the unreasonable man. It rewards the reasonable man saying, you know what? This doesn't make sense to me. I'm out. I'm just going to sit in the sidelines and watch. And I know that's tough. It's hard sitting on cash, hard sitting on your hands. I tell you, is one of the hardest things to do. You're like, oh my God, it's a dip. I want to buy. Maybe just wait. What if the market drops 50%? You're going to be pissed that you're not sitting on the sidelines. What if the market jumps 5% from here and goes back to all-time highs with no news, right? If he says the war is over, I'd say, okay, let's see a little continuation of that. If that continues, maybe I'll jump in. But I don't know what's going on now, because the news is not all that clear to me. I know what we're hearing, but it's not clear to me. It sounds like propaganda. So until we have clarity, I'm just going to wait. And I think that's probably the best advice I can give anybody. And I'm not giving you advice. This is not investment advice. But here's what I'm doing. Here's how I see the market. And it's probably a framework you should consider.
This is a public service announcement. Hi, my name is Kirk Chisholm, and I'm with the government, and I'm here to help. Doesn't that sound reassuring? Well, let's talk about how they're helping. The government needs your help to make our money worthless again. PPP loans, student loan forgiveness, helicopter money. Let's keep the party going until our money is totally worthless. Don't think it can happen? Sure it can. Just ask Zimbabwe, Venezuela, Greece, Germany, Hungary, Greece, Yugoslavia. Did I say Greece? As a loyal listener to their show, I want to give you free money. I'm giving away free money in one of these hyperinflationary currencies. Go to www.moneytreepodcast.com/free money and follow the instructions to get your free gift. I have a large audience and only a limited supply of these currencies. I'm not the Federal Reserve, so I will run out at some point. Make sure you get yours before I run out. Go to moneytreepodcast.com/free money. Follow the instructions and get your free money today.
Well, I mean, do we have 2 hours, 3 hours here today?
Oh, God,
are we going long? We having a special edition here because I can keep going.
It's St. Patty's Day, Doug. Let's start drinking.
But
we're a little late for that.
Man, I did not come prepared. Well, you said a couple of things, and I'm just going to prepare everybody. I'm going to be on a roll for analogies today because it's just so much to play with. Backing up in a couple of things when you talked about predictions, and and they always predict it's going to be better. Actually, I've just posted this Wall Street 2026 year-end target for the S&P 500. Oppenheimer predicted 8,100. Deutsche Bank, they predicted 8,000. Capital Economics predicted 8,000. Morgan Stanley predicted 7,800. It goes on. Most of them in the mid 7s to 8s. I mean, if you go back to 2008 before the crash, everybody was predicting a wonderful year that year as well. So, I mean, these predictions are like, what's. Everybody's got them, and they never predicted. They're the the bears out there. Don't get me wrong; they're always predicting it wrong. But the ones that are actually trying to make reasonable projections never predict that things can go wrong. And the reality is that there are some out there that were predicting that after the Liberation Day, tariffs and the crash from that it would work its way up, and it did, but not to these exponentially ridiculous highs, and it was before everything else happened. And Brian Westbury, giving credit where credit's due, he posted the other day that if the wealth effect spending is really driving our economy, and he posted a graph of the S&P 500, he goes, it's going to be very hard to keep up with this performance. And that is absolutely true. You cannot, it is really, really difficult to continue to push this with spending. When we all know at the bottom, that there is an erosion of how far that spending can go right now. And as you said, if with oil jumping, there's a high probability things are going to get more expensive. And at some point, even the people that can afford it are going to start pulling back. Now, I just learned something about 2 minutes ago, and some people listening may have already heard this. But Kirk, I don't know if you heard this. Chuck Norris just passed away.
What?
He an emergency procedure. He went in. He did not make it. And I'm just going to use this as a kickoff for everything I'm going to talk. All these analogies I'm talking about today. If Chuck Norris can die, then let's stop pretending the economy is invincible.
That's bullshit. He didn't die. No one can beat Chuck Norris. Not even life.
I mean, if he'd ever worried about market crashes because the market checked with him before it dipped. But listen, for decades, we've treated the markets like they're bulletproof, like nothing can take them down, just like Chuck Norris. Nothing can disrupt them. But unfortunately, it's fun to have a meme. That's the illusion. These strong economies are just a collection of fragile systems. Debt that has to be serviced, confidence that has to be maintained, liquidity has to keep flowing. And just like Chuck, it looks unstoppable, but it is until it isn't. The real risk isn't collapse. It's actually complacency. Because the moment that people believe that something can't break, that's when it usually does. And so the question isn't really, is the economy strong? It's where are the cracks that no one's pricing in yet? And you said something earlier about Iran and your son and asking, hey, what's going on there? And the answer is, I don't know. It depends on where you get your information from. And that reminded me of a little bit of analogy I'm going to put here of going back to the Beastie Boys. And I listened to this yesterday, the song of some people, a lot of people, I don't think you have too many teenagers listen to this, so I'm sure a lot of people know this song, So What You Want. It isn't a narrative song. It's defiance calling out fake narratives, questioning sources, exposing people who don't know what they're talking about. And that's that's really something that we have to take away from something like the Iran war-driven economic narrative. Let's start with that. One of the lines is, "Where'd you get your information from?" That is basically the whole bridge. It's calling out fake persons, fake narratives, people pretending to know more than they do. In a war economy context, it's, who's driving the narrative about Iran? Is it media, politicians, markets, defense contractors? I mean, you think you confront when revelation comes. That's the next line. And that really, the truth is eventually going to expose bad assumptions to markets, policy, and intelligence failures. They make, another line in it, funny with the money that you flaunt. Now, this is gets interesting for the world with wealth and macroeconomics. This is in the song, it's mocking superficial displays of wealth and status. In war economies, they always create visible winners and hidden costs. Defense spending, that's going to spike. And there's been, that's something that, certainly to note, because, there are companies being told right now, if this war continues, we're going to need you to be ready because we're going to have to put these orders through and you're going to have to be prepared to fill them. Oil volatility, markets rallying on conflict in the short term. Meanwhile, you've got a continuation of debt inflation and long-term drag. Funny with the money that you flaunt. With our conversation today, it's governments and markets acting strong while quietly leveraging the future. Another line from it I wrote down, I've got eyes in the back of my head. Pure strategy. Smart capital is not reacting. It's anticipating second-order effects. The conflict implications, oil supply shocks, again, leading to inflation, like you said. Fed policy shifts from there that clearly don't want to have high oil going into these midterms. A lot of what's going on right now, again, I'm not in the boardroom, the war room, but there was clearly a belief that this isn't going to be something that's going to drag us all down. That's not good for midterm. So, the timing, very optimistic. The reality, we'll see. Defense sector can boom, but consumers can be squeezed. And currency movement, well, we're already seeing U.S. dollar strength versus global instability. Ultimately, I realize that the investor who sees past these headlines win. Couple more things. I think I'm losing my mind this time. It hits a lot harder in a geopolitical lens. Markets during these escalations often do feel irrational. Again, stocks up on bad news. What? Oil spiking, then collapsing. Policy responses lag reality. Chaos isn't random. It's mispriced uncertainty. And so again, the hook. So what you want? What do politicians want? Do they want stability or do they want control? I don't know. I'm not in those conversations. What do the markets want? Do they want liquidity or do they want the truth? What do investors want? Do you want safety or do you want opportunity? So just kind of get away from that. I mean, the Beastie Boys weren't writing about geopolitics, but they nailed the psychology of it. All of this, where'd you get your information from is the same question you should be asking every time the headlines start, driving these markets. Because when the conflict narratives form, especially around something like Iran, big country, a lot of conflict, a lot of history, a lot of things, interconnected challenges. You're going to get noise positioning and money moving before the truth shows up. And like the song warns, you cannot front when revelation comes. Okay, so just be prepared for that. And again, the other thing I wanted to tie in, and I kind of started that a little bit this morning, is we are talking about a great opportunity to look at from a fun play of March Madness. All right, March Madness, as I said, unpredictability, momentum shifts, upsets. That's what we're seeing in the markets right now. So what's segment one? The seeds. Okay, the seeds are vulnerable. Who are the seeds? Who would you call the seeds? The number one seeds? To me, it's Mag 7, it's big tech. Every March, top seeds look unbeatable until they're not. If anybody was watching yesterday, There's been a couple of upsets. Not a top seed, but UNC went down. Sorry, Matt. But Duke was losing by 10 at halftime. Right now, we're starting to, markets are starting to question whether the top seeds, which again, Mag 7, can carry the entire market again. Leadership's narrowing, valuations are stretched, rotation. We talked about this a couple weeks ago. It's beginning. The markets are built on a handful of names, and they've been this way for a long time. Just like brackets are built on favorites. And one upset, looking at my bracket already, it changes everything. Now, who's the unexpected underdog? To me, I think that's oil. Every tournament, there's a team nobody planned on that suddenly takes over. And this year, nobody was really talking oil a couple months ago. Now, oil was beat up, and if you follow trends, anything that's beat up, higher opportunity to go up, and we can see normal rotation. Nobody was expecting we were going to be in conflict, and especially around the Strait of Hormuz. So energy wasn't the story. Guess what? Now it is. A lot of other stories, I'm not going to get into the politics and headlines of that. They all of a sudden went real quiet. Welcome to the media. Iran conflict, that's volatility injection. Inflation risk is re-entering. So oil just went from a 10 seed to a Final Four contender in 1 week. Now, who's playing defense? Some teams get in there. They're not the shooters. They're the ones that slow everything down, and they tend to do well. That's the dollar. The dollar right now is that. It's the flight to safety, tightening financial conditions, pressure on global liquidity. Kirk, we talked about banks or financials, why they're doing well. Because the reality is investors are irrational. Where are they going to move their money? They're going to move their money to something that feels safe, even as we know, and this is an old saying by Warren Buffett, you don't know who's swimming naked till the tide rolls out. Ironically, in finances, we've already seen the tide roll out. We know they're swimming naked, but yet, safe play. So the dollar's not going to win games, but it's going to slow it down. And right now, it's slowing the entire global economy. The injured star player, segment 4, housing. We're going to come back to that. Every tournament has a key player. It's not 100%. That's housing right now. Mortgage rates are ticking back up again. Affordability is still broken. Transaction volume, weak. Housing isn't collapsing, but it's definitely limping, and it's not running out on the floor. Couple more here. Segment 5, the consumer's fatigue. Consumer has carried the team all season. I talked about that. How long can we keep the spending pushing everything? You're starting to see it. Rising debt, energy costs hitting budgets, spending shifting to essentials. They haven't left the game, but they're definitely asking for a timeout. Debt is the next one. Hidden weakness. No one fills out a bracket thinking about conditioning, but that's what wins games late. Debt is the conditioning problem in this economy. With those high interest rates and refinancing risk and private credit exposure, starting to see defaults there. Debt isn't hurting early in the game, but it is something that when things are good, great, but it shows up when you're tired. That is why high yield, which is starting to get a bigger spreads, is something that we generally see problems in as the economy starts to crack, and it tends to be a place that people are okay with when it starts to expand. Now, I'll go back to the banks for a second, Kirk, and I got a few more. They're the referees. They're like the refs. When they tighten, the whole game changes. Lending standards, that tightens again. Private credit stress, liquidity risk. So when those banks tighten, it's kind of like the refs calling everybody. Suddenly, nobody can play the same way. Now, segment 8 on this, is this a blowout or just a close game? And that is a big question. Are we seeing a collapse or competitive game? Right now, rotation, yes. Panic, not yet. Liquidity stress, not yet. Still looks like a tight game, not a blowout. 2 more here. Media. Coming back to that. So I'm tying all this together for you, Kirk. All these points coming in one. It's the hype machine. March Madness thrives on hype. Nobody cares about basketball purists love the regular season. But we all know one of the arguments, and people follow college football, one of the arguments of the playoff was, nobody's going to care about the regular season. And is it going to become like basketball? And basketball has definitely built this couple-week period here as everything. It is the hype machine. It thrives on it. And so does financial media. Headlines amplify fear. Narrative shifts fast. Short-term emotion over long-term reality. And the media is going to call every run a comeback and every dip a collapse. So just be prepared for that extreme noise either way to sell those clicks. And lastly, where to be positioned. What's your bracket strategy? When March Madness, you don't bet everything on one team. You diversify your bracket. Lots of people were calling for Duke. They almost lost in the first round. They came back, so they're still in it. We'll see. They might get the momentum. Right now, playing well, energy, commodities, select defensives, cash flow businesses. And none of it, Kirk, neither of us are saying jump into it because the war throws a lot of things. But what is at risk for sure? Overvalued growth, rate-sensitive sectors, over-leveraged companies. It is not the environment to go in on one team. This, more than it's been for the past 15 years, is about building the diversification. We're seeing that in the rotation and building a resilient bracket. Overall, the market isn't broken. It's being repriced. And like every tournament, the story is going to be changing in front of you in real time. If you've got bracket challenge by ESPN, March Madness is going to teach something about what the markets do too. The best team doesn't always win. The team that adapts does. And you're going to see a lot of blips and changes and surprises and all this stuff that's going to happen in a short period of time. Breathe and come back to logical thought and really revisit and make sure that things are going to be good right now. And as you said, don't just buy the dip. This is not like, a blip. There's a lot of things that can hit all at once. So.
Yeah. Well, that's good. It makes me want to go watch March Madness, Doug. So I want to talk through a bunch of different specifics here because we talked about the bigger framework. I want to start talking about maybe a level down into the framework. So some things to think about. We talked about war, how it's uncertain, but there's a lot going on behind the scenes that you're probably missing because of the war. It's kind of crowding it out. One of them is the financial sector. The financial sector is a bit of a mess. It's up a little bit today. I don't know this to be true, but I heard a rumor that they changed the rules for banks again, so banks don't have to be as particular about who they lend to, where after the financial crisis, they put in some pretty stiff rules, and apparently they just lightened up those rules yesterday, so I've heard, which means banks take a whole lot of risk, which means that the failing banking sector might not fail because they just went back to mark to magic accounting. So I have to check if that's true. I just saw it. I just want to mention it. But regardless, you still have a problem, right? In the private credit space, it's a complete mess. Wells Fargo, I believe, in the chart we showed last week, is most exposed to this in the warehouse lines. But so the big banks are all exposed. JP, Bank of America, they're all exposed. But I think Wells Fargo has like twice twice as much as the next one. So, here's some things to think about. Okay. If you look at triple B corporate spread, right, it's basically triple B's compared to the 10-year treasury. And if you look at treasuries as risk-free, now 10-year treasury is not risk-free, but if you look at treasuries as kind of like the risk-free version, like there's no risk of it defaulting, or as close to zero as you can get risk of defaulting on the treasury. And you compare that to like a triple B corporate, which is still investment grade, but the lowest of the investment grade. And the spread is going up. And what that means is that when times are tricky, when people are concerned about the companies repaying their debt, that spread tends to widen, i.e. the chart goes up. So you look back last year around the same time, it spiked. Well, that was during the tariff tantrum because a lot of people didn't know what was going on. And I think that was probably a little bit silly, but that's what happened. But as you can see over time, it just keeps dropping and dropping and dropping, which is kind of odd. It means that there's no risk in the market. Well, usually these are the times where there's a whole lot of risk, right? Is when the spreads are really narrow. But it's starting to go up, which means the market is pricing in risk a little bit more now. So you want to watch this. So you want to watch that. There's a lot of indicators you want to watch. One of them is the corporate bond and 10-year. Any variation of this, they're similar versions. You want to watch the treasury versus corporate bonds. You want to see where that spread is. You also want to look at high yield bonds. What's the spread there? Are high yield bonds paying a higher yield now than they were before? well, that's an indication of concern of risk. That's Doug's chart from earlier. Here's what I was mentioning earlier. Here's a chart of the S&P 500. If you can see here, the market really hasn't gone anywhere for pretty much since September, mid-September. So we're looking at basically 6 months, the market's gone nowhere. 6 months, and the market's gone nowhere. So if you're wondering, like, why am I not getting 30% returns this year? Look at the markets. The markets haven't gone anywhere, right? And here's another thing I want to share. So if you look here in April of last year, you see this big dip. That was the tariff tantrum, right? This is when the markets dropped like they weren't quite 20%, but maybe it was 15. It was a decent amount. Maybe it was close to 20. So they dropped a lot, right? And then they bounced back, and they've done really well if you bought at the bottom, which of course nobody does. And they've done really well since. Now, what's going to happen a month from now? That dip is no longer going to be there. Now the 12-month lows are going to be about maybe 800 points higher. And then what's going to happen a month after that, and a month after that? So 6 months from now, if we're still in this place, the 12-month lows, meaning what's happened in the 52-week lows, what people refer to, it's going to be where you are now, assuming the market doesn't drop from here. Well, that makes things look terrible. Oh my God, we're at the 52-week lows. Well, people say that, and it makes you freak out. Oh my God, the market's crashing. It's the 52-week lows the whole year. Oh my God. Well, look at the chart. It's gone nowhere. So Wall Street does this two-step frequently. Well, they'll say things that are technically true, but it's not the whole story. So let's just say the market's here where we are today, 6 months from now, okay? And then it dips, and we're at the 12-month lows or 52-week lows. That's going to freak a lot of people out. But the reality is the market hasn't gone anywhere. So sometimes the message or the narrative being pumped out is, oh my God, things are scary. You need to get out of the markets. Well, that would be silly because the markets haven't gone anywhere. I wouldn't be afraid of the markets if they were a 52-week low when the markets literally went nowhere for a year. That wouldn't freak me out because I'm looking at a chart and I'm seeing exactly what the history has been like for the last year. But most people just hear the headline and they say, oh my God, that sounds bad. I should freak out. I should take money out and put it in cash and do all the bad things. Well, that would be a bad idea. So you want to have a sense of where the market's going. Now is not a time to necessarily freak out. I think if we go below the November lows, then you probably want to be concerned because there's a lot of support at those lows. But I would be a little concerned if it goes below there. I'm concerned anyway, but I would be more concerned if it went below that. But then you're bringing up the next support level, which is really a year ago, which is about 15, maybe about 12% lower, 12 to 15% lower from here, which I think is where the market should be now anyway, but it's not, and it doesn't matter what I think. The market doesn't listen to me. I also want to show this chart here, which I don't know if you remember, but back in 2022, 23, where if you were in stocks or bonds, you lost a lot of money. Everything went down. When interest rates went up, everything went down. Stocks and bonds lost money. Because when interest rates go up, bonds lose value. So they go down in price. So when interest rates climbed, because we were at 0 and then we climbed up to 5 and change on the Fed funds rate, that was a big jump. Well, if you were in the 30-year treasuries, I believe they lost 50% value. These are U.S. Treasury, government guaranteed U.S. Treasury bonds for 30 years. They're guaranteed you if you hold to maturity that you'll get your money back in interest. That's what they're all about. And those lost 50% value. So if you were buying those, you lost 50% of your money in quote unquote safe bonds, right? They're government guaranteed. So they're as safe as you can get with what we look at in the investment world. It's not guaranteed. I'm just saying government guaranteed. It's guaranteed by the government. So my point is that nothing's guaranteed, but you would have lost half of the money you put in there being in safe bonds. Not a good idea. Well, what happened during that time is what we call correlation alignment. So typically bonds and stocks have an inverse correlation. One goes up, the other goes down. One goes down, the other goes up, and it's an inverse correlation. And that's what people have been doing in their portfolios for decades to balance risk. But what happens if they're correlated? What happens if stocks go up and bonds go up, or stocks go down and bonds go down? Well, there's no point in having diversification because you're getting the same result. The idea of diversification is to have independent results that offset each other. So if one thing's doing badly, something else is doing well. But if markets are all correlated, then you just own one thing. You don't need to diversify it. That's the problem with correlation, right? And I'm not suggesting you do that, but I'm saying in that environment, that's how it works. If you own the S&P or you own, Mag 7, if you own energy or whatever it is, if everything's correlated, then everything gets pretty much the same results. So you can own one thing and it's like owning anything else. That's what you don't want. And markets for the last 5 years have become more highly correlated. You can see from this chart is that, starting 2020, everything started to correlate a lot more closely, which means that you have to be really careful. You can't rely on a 60-40 stock bond portfolio to protect you because that's not risk management. I know Wall Street will tell you that, and all the textbooks will tell you that, but that's only if you have an inverse correlation will it protect you from volatility, not risk, volatility. So, for instance, in 2009, 10, actually bonds correlated too, but if you look back then and you were in bonds and stocks, well, stocks dropped 60% and bonds didn't drop as much. They still went down. But either way, let's say they went up. That would have protected you. But let's say that happens now. Bonds and stocks go down. Like if we have stagflation, which is what everybody's afraid of. Well, that's a problem because that means you're going to lose money no matter what you put your money in. That's when cash is a really good friend. And that's why cash is so important because you don't know when there's high correlations, you don't know what the impact's going to be. So I'd be very careful right now with correlations in the market. Be very careful of what you own. Don't assume that diversification is going to protect you because it may not. I'm very, very careful about correlations right now. And I am not assuming anything. When the markets get squirrely, everything goes out the window. All the rules, the rule book goes out the window. You just have to really pay attention and protect yourself. That's why, if somebody starts a war, you get out, you come back in later. I don't know what's going to happen, but I'm okay sitting the sidelines until I see there's a direction. Maybe bonds go up, maybe they go down. I have no idea. Energy stocks are about the only thing doing well right now, and oil. But everything else is getting crushed, and that is what can happen in these times. So just be very careful with your portfolio. I don't know if the stock market's going to get worse. I don't know if Trump's going to come out next week and say, "Hey, we won. We're all set. Everyone's back to normal. We all agreed that the old Iranian regime was terrible and the new Iranian regime is going to be great, and we're going to be in control. Marco Rubio is going to be over there wearing his turban. He's going to run everything. It's going to be awesome." I don't see that happening, but let's just say it does. I have the right to change my mind. But for the moment, sitting on the sidelines seems like the safest place to be, at least until we have a direction of where things are going. And then lastly, I want to share three more quick things. I'll give it back to Doug. So this is a chart of stock market corrections. So it looks at the average number of corrections a year. 3%, about a 3% dip. 3% or more dip happens 7.2% to 7.2 times per year on average. 5% or greater, mild correction is 3.5 times per year on average. A 10% or more is about 1.1 times a year. 15% correction happens about every other year, and then a 20% correction is about every 3 years. So on average, over long periods of time, those are the numbers. So last year we had, let's say, a 20%, right? And so we could say, well, maybe we don't have one for another 2 years. Not saying that's going to happen, but keep in mind the statistics is that people worry about the market melting down and going to zero and all this. And you got the clowns out there saying that the gold is going to go to the moon and the market's going to go to zero and the dollar's going to zero. Good luck to them because you're going to lose a lot of money if you buy into that perma bull, perma bear kind of thinking. It's not good thinking. It will cause you to lose money. Whether they're correct or not is irrelevant. It's the fact that they're not thinking about it that's the issue. So, all right, this is something that I'm not going to spend a lot of time on, but this is basically looking at how the stock market is measuring price targets and volatility. It's just looking at probabilistic outcomes. And right now, the most probabilistic outcome is for a 14-day conflict, which of course we're over, is about $48 oil. We're right around 50, which I think is actually where it's going to be. I think it'll be somewhere between 40 and 50 by election time. But of course, as things go on, that may change. But this is something that you could look at and say, okay, here's how we're looking at the markets. The last thing I want to say, before I hand it back to Doug, is the housing market. If you haven't heard this, I've seen a lot of this lately, is that there's a divide between new home sales and new homes being built. A lot of new homes are being built and they're not selling. Keep that in mind. People have been talking about the supply and demand problem for years. A lot more houses are being built and a lot fewer houses are being sold. So this is just a piece of this, new house versus existing house. A ton of new houses are being built. Now, what I think is happening is home builders are building in advance of the need, which should come down the road. But home sales are not picking up. It's a real problem. We're starting to see this. A ton of new homes are coming to the market. Existing homes aren't. People aren't moving because they've got a low interest rate. You've got people who can't afford a new house. You've got this problem. The only solution is lower interest rates. Otherwise, you're going to have a glut of housing that just doesn't move. You got people want too much and people can't afford too much. So houses don't sell. That's what's going on now. It's probably going to continue. It started last summer. I saw it when we were buying our home, and I guarantee it's going to keep continuing until interest rates drop. So we'll see what happens. Doug, final thoughts here from you.
Yeah, adding on to that housing side to close it out, before I wrap up, I just talked to a custom home builder, and they're still doing really well. I mean, it's softened a little bit, but what they've said basically is you got to look at what their demographic is. They make custom homes, so a lot of the people that they're selling to are people that they sold to before that are basically, they might be, affluent and downsizing, but they're downsizing to a smaller home that this firm is going to build. That's still going to be at the same price point for a smaller home with all the amenities of the place that they had that was too big. So again, who's moving here? It's the haves into the wants. He is seeing some new buyers in that demographic that are, again, a lot of them already have an existing home and are at the point of downsizing or making a change. The issue here is the housing market cannot survive off of just people who already have a tremendous amount of home equity being the only ones that could potentially move into something else. You can't just have the top tier moving and not the bottom. I mean, homes were a major component of the next generation, the younger generation, being able to evolve economically into the development of their families. Now we add into the fact that, again, that's also got a whole different situation that's going in there with regards to lowering of birth rate. It was a way of basically helping to transition them to an area in which their wealth would be able to take off, and it is and the unaffordability of it is starting to creep in both financially and psychologically. And to me, the bigger concern here is going to be the psychological impact of how difficult it is to be able to make that transition. Now, there is a financial component to owning a house, a psychological, emotional component to having a house. I would say psychological, emotional is a much bigger piece of that component, because on the numerical level, it's been sold as you have to have a house, you're building wealth. Well, I mean, there's a lot of other costs that come with it. Mathematically on the table, in many cases, you'll find that owning a house is overall more expensive than renting of similar capacity, and a lot more headaches. But, again, the emotion of it drives a lot of things. So when you start to erode that, it can have, continuing lingering effects that creep into other areas of the psyche of the economy. So we do need housing to move. I'm going to go back to the analogy. Housing is the bubble team. Every March, there's a team that's sitting right on the edge. It's not eliminated. It's not dominating. It's just surviving. And that's housing right now. Just some more data there. Mortgage rates are moving the wrong way again. They're back up to 6.2, 6.3%. We already had, there was a prediction we would start to see some things moving in the spring when it should. That's not going to help. Again, war, inflation fears. It got a little bit of breathing room, and then the rates turn right back around. The demand has been trying to come back, but it's fragile. Pending home sales plus 1.8% month over month. Existing home sales ticking up slightly, but still well below normal activity levels, approximately 4 million to versus 5 million typical. So there is some demand there, but it's very hesitant. These rates are not going to help, and it's like a team afraid to take a shot. Inventory is rising, but not enough. It's up about 2 to 7% year over year. It's still below pre-COVID levels. Slight relief for buyers, but still structurally undersupplied. We're still playing effectively with a short bench there. Prices, they're quietly softening. Listing prices down about 2 to 2.5% year over year. That's 20 plus weeks continuing of flatter declining prices. That's not a crash, but it's definitely a slow bleed. And we're also starting to see foreclosures rising again, up 12 straight months, about 38,000 plus properties affected, according to the New York Post. The foreclosures aren't exploding, but they're quietly trending in the wrong direction. And this isn't even to get into commercial real estate, where actually I may have just posted, I don't know if I posted up there, but let's just say there was a post about 10 properties in Denver, commercial properties. Let's just put it this way. Properties that a couple years ago were selling for hundreds and hundreds of million, $400 to $900 million properties are now selling for under 50 million. Some of them under 30 million. That's insane for a 40-story building in a major metropolitan area. Commercial, and this goes back to bank risk. The commercial property real estate is in an incredible rut, and there is very, granted, if you can buy it and hold on to it, you might be buying an incredible value in the future, but it's going to be an expensive value for the future that you're going to have to hold on for a long time to get this back. It is there's no easy exit strategy on commercial real estate. So again, rates being too high, that kills affordability. Supply too low, that supports prices staying high, and weakening consumer, that's going to limit demand. You're ending up with a stalemate. So we are stuck in overtime. Housing again, is the bubble team. It's surviving. It's not thriving. It needs lower rates to advance, and one bad shock equals elimination. And so, we're looking at oil and inflation risk. That puts pressure of rates to stay higher. Housing pressured. The jobs, weak demand weakens. Banks tighten. Mortgage, again, you may have heard that they're loosening things. We'll see, if it happens, but generally mortgageability tightens as they look at, risks going up. So housing doesn't exist in a vacuum. It's where all the other forces collide. By the way, another reason to worry about, buying the dip right now. I know you look at the markets and you say, wow, it's pulled back. There's got to be some great values here. Interesting enough, I'll use it again. Brian Westbury actually posted a stat, said that because of the rising bond yields, even though the market has pulled back, we are actually in a more overvalued market than we were, the last several months. So yeah, it looks like those deals are out there, but on a fundamentals level, it's actually worse. So the prices have come down, but yet they've, the value of what they should be has gone down even further. So just be extremely careful. So to wrap this up today, I just want to zoom out. March Madness is all about momentum, upsets, brackets getting blown apart. That's exactly what we're seeing in the markets right now. I mean, not necessarily blown apart, but your brackets getting blown apart because what you think was going to happen, you're starting to see those upsets. The narrative just a couple of weeks ago before Iran looked clean. They were talking soft landing, rate cuts coming, strong consumer. Now we've got war escalation, which, and if we can get out of it, everything could change. But if we stay in it, the longer we're there, the more unpredictability. Oil, and the more it creates issues in other areas of the economy, fiscally, psychologically, the consumer. Oil volatility, weakening jobs, housing on the bubble. The bracket's busted. And in times like this, you got to ask the most important question. Where'd you get your information from? Huh? Because when the headlines start driving the markets, especially around something like Iran, you're not getting clarity. You're getting positioning, incentives, money moving before the truth shows up. And just like the Beastie Boys track reminds us, you can't front when revelation comes. Markets eventually expose what's real. Oil doesn't care about narratives. Consumer doesn't care about spin. Debt doesn't care about optimism. Right now, what we're seeing is a market that's trying to figure out what it actually wants. Liquidity, reality. Growth, stability. Short-term gains, long-term sustainability. So what you want? Because your answer to that question determines how you invest. This is where most people get it wrong. They react, they chase, they build portfolios for the last game, not the next one. At Mergent Advisors, my company, we take a different approach. We help families map out everything: your income, your debt, your taxes, college funding, retirement, so you can actually see how your plan holds up across all cycles. Booms, busts, melt-ups, meltdowns, even moments like this. The goal isn't predicting the next upset. It's building a strategy that survives the entire tournament. The difference between reacting like a thousandaire or thinking like a billionaire. Preparation over prediction, structure over noise, clarity over chaos. If you want to see how your plan stacks up, visit our website, mergentadvisors.net. MERGENT, mergentadvisors.net. Start the conversation. We'll simply map it out, see where things are, talk about what you want, look at what you have, and give you clarity on where you go. In the markets and in March Madness, winners aren't the ones who guess right. They're the ones who are built to last. And we'll see you next time.
That's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.